think the buying opportunities in silver, we should talk about, I think that's important, really depend on your individual time horizon and profile. I mean, I see silver well over $300 coming very quickly. So whether I buy silver at 70, 90, 100, or 60 is not terribly important if I'm a longer term player in the space. When you and I were both in Vancouver earlier in January this year, when Rick Rule was announcing he was going to sell his silver before its top. Well, why are you selling before it top? But if Rick bought at 10, 17, 50, or even 45 silver, does it really matter whether he didn't wait till 120? In other words, what is enough for each of us and why are we investing in it? Now, I'm an investor in silver, not a trader. And I look at the ratios for the entry and ratios for an exit. But even when I exit, usually when I'm looking at a ratio of at least 30 into the high teens, gold-silver ratio, I'm just going to use it to buy gold, which will be undervalued at that compression.
Global financial markets are entering a period of increasing uncertainty, with investors seeking assets that can protect wealth from inflation, debt expansion, and currency debasement. At the same time, precious metals are attracting renewed attention as concerns grow over the long-term stability of the monetary system. Matthew Piepenburg, a respected macroeconomic analyst and precious metals advocate, explains that the real story is not simply rising metal prices, but a growing disconnect between financial markets and the realities of physical supply. He argues that gold remains the ultimate monetary asset, while silver offers a unique opportunity due to its combination of monetary and industrial demand. According to his view, years of persistent silver deficits, rising geopolitical tensions, and increasing demand from the technology, energy, and defense sectors are creating conditions for a significant repricing of the metal. He believes investors should focus less on short-term volatility and more on the broader trend, noting that silver prices could move well beyond $300 as monetary and supply pressures intensify. Now we present the clips from Matthew Piepenburg's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Gold and silver are monetary metals, and I think in a monetary crisis, they're both going to have tailwinds. But you're right, central banks aren't stacking silver like they're stacking gold as a store of value or basically the de facto reserve asset. I think for silver, it's a little bit different, I think, in the sense that I think there's things that I looked at silver and I still think matters. Silver has got technical and basic supply and demand forces, but I don't think it acts quite the same as a monetary reserve asset as gold. And I think the buying opportunities in silver, we should talk about, I think that's important, really depend on your individual time horizon and profile. I mean, I see silver well over $300 coming very quickly. So whether I buy silver at 70, 90, 100, or 60 is not terribly important if I'm a longer term player in the space. When you and I were both in Vancouver earlier in January this year, when Rick Rule was announcing he was going to sell his silver before its top. Well, why are you selling before it top? But if Rick bought at 10, 17, 50, or even 45 silver, does it really matter whether he didn't wait till 120? In other words, what is enough for each of us and why are we investing in it? Now, I'm an investor in silver, not a trader. And I look at the ratios for the entry and ratios for an exit. But even when I exit, usually when I'm looking at a ratio of at least 30 into the high teens, gold-silver ratio, I'm just going to use it to buy gold, which will be undervalued at that compression. Because I'm looking at these metals as monetary metals. But to your point, there are fundamental forces of supply and demand outside of just the monetary system, in the industrial, in the military, in the energy sector, which require silver. And those demands are higher now than ever in a conflict-ridden backdrop that we're sitting in. But, I think with silver, you got to look at supply and demand. I still think that matters. We all know that we've seen 5 or 6 now consecutive years of 200 million ounce silver supply deficits. That's not just something to memorize. It's something you got to think about. That's over $1 billion and 1 billion ounces in supply deficits. So, and we look at the COMEX, the registered or available silver versus the open interest or the demand for silver. The ratios are off the charts. I think we're heading towards a cash settlement only COMEX. I've said that as far back as January. And if you look at the lease rates on silver, my entire career was rarely above 1%. Now we're well over 8%. So these are supply and demand forces that are really important, Jess. And I think the military industrial demand, remember, silver is a byproduct mined metal. You can't just create supply with the push of a button. And, solar panels, electric vehicles, military, that's even more demand now than reported. So this massive supply deficit at a time when silver is now on the critical minerals list as of last year, In a war where silver is an element for these weapons and EV adoption is rising and solar has more installs, it makes for an even stronger bull case on supply and demand. And I'll end with this because I think it's important on the technical side, and I'm not a trader, but of course I want to look at the direction or the signals. The last time we've seen something like this has been a while, but I see a bullish rather than bear case in silver when it dips beneath its 200-day moving average. I know that sounds kind of wonky, but it's very easy to track. This 200-day moving average is a massive signal for me. And again, I'm not even a trader anymore, but it's in my DNA to look at it. And the last time silver fell below this average was in April of 2025. And that was just before the metal, which was then trading at 27, ripped north by more than 26, by over 200%. Historical multiples, historical new highs. And prior to 2025, we saw a similar bullish signal when silver tipped below the 200-day moving line. That was in 2020 when silver was around $10 or $11, and then it ripped. And in 2022, the same thing. It touched that moving day average line when silver was at 17 and then continued to go north. So I think the technicals and the supply and demand fundamentals are massively important signals for the metal, for silver. By the way, that same 200-day moving average indicator where it dips below and then rips is actually the same thing in gold right now. So both metals at a technical level are positioned very well despite the retracements. But again, it's about your profile. Are you investing as a trader? Are you looking to leverage long and short? Are you looking to arbitrage? Or do you see these metals as monetary solutions to openly dying fiat money? I look at them both. Silver will have a better beta trade to gold when gold hits another bull market run, which it will, and we can talk about why. But yeah, I'm very bullish on both. Of course, people are going to say that's selling your book. But again, if you're a longer term investor, you can afford to be the most important thing of all when you're investing. That's patience. And patience comes from conviction. And the conviction comes from understanding the debt crisis and the debasement trade to monetize that debt. It's really a fat pitch to me. And, I'll keep saying this because we haven't gotten started on the bull market yet in gold. And so silver will track it, but for different reasons.
One of the most important themes discussed is the difference between investing and trading. Rather than trying to predict every short-term price movement, the focus remains on long-term value and the changing relationship between gold and silver. The argument is that investors should focus to the broader monetary backdrop rather than be distracted by temporary corrections. At the same time, supply fundamentals continue to strengthen the bullish case. Several consecutive years of silver deficits have reduced available inventories while demand from solar energy, electric vehicles, military applications, and advanced technologies continues to expand. Rising lease rates and tightening physical markets suggest that obtaining metal is becoming increasingly difficult. Combined with growing concerns about sovereign debt and global currency risks, these trends could create powerful upward pressure on prices over the coming years. For many investors, the current environment represents an opportunity rather than a reason for caution. Now, let's get back to the interview.
I think you make really good points. I think, and again, I'm not trying to be condescending. There are many brilliant retail investors. There are many stupid professional investors. So I think it's not just the smart money and the dumb money, but when gold takes a major 20% or greater dip in such a short period of time, people just think, well, the gold trade is over. The innocents just get out. And with that, the baby goes out with the bathwater and the mining side as well. And I think it's an important disconnect and an important misunderstanding we should clarify. Again, I have to be clear. I am not a mining expert. I am a very boring monetary metal thinker. Von Greyer's is a gold company that sees gold as a wealth preservation asset. It's life insurance play on openly dying fiat money. The mining experts that I know and that I trust, the Pierre Lassans, the Frank Justras, the Rick Rules, are far more eloquent in this space than I am. Nevertheless, I know enough to be somewhat dangerous or helpful in trying to look at the bigger picture on the miners, the explorers, and the royalty companies. In the gold equities and silver equities do have an impressive amount of leverage built in. Typically, if gold is up 10%, then miners are up 30%. So on the surface, it's obvious. When the cost of production at a place like, Agnico Eagle is 100 or 1,400, and say gold's at 4,400, it's an obvious profit when the spot price is significantly higher than the cost of production. And so in those kind of mining companies, it's a fat pitch. You look for insider ownership, or in cases like wheat and precious metals, you look for political ownership if Trump is buying. But I mean, It is a fat pitch when the cost of production is so much lower than the spot price. The spread is a fantastic opportunity that I think many are missing because they're looking at, as you said at the beginning, tweets, day-to-day thoughts, clickbait to keep things moving. They're missing the bigger picture. They're missing the forest through the trees. It's the same thing with royalty companies. They finance the miners and get royalty for their metals. There's some incredible value in some of these companies when they're a little bit oversold. Like, I'm not allowed to say this, I'm not a pundit for it, but like Franco-Nevada, these are opportunities in the royalty space. But I think to answer your question beyond just the paranoia and the schizophrenia and the Twitter cycles and the clickbaiting that goes on in this space and the pundit fear selling and even the pundit apologists, which some could claim that we are, I think my experience from Wall Street, and that's going back decades, but I still see it today, that the generalists on the street don't necessarily push the miners because they often don't trust the management or the leverage or the consistency. And we've seen this year after year, certainly recently, where some of these miners the sector had the highest free cash flow, but the lowest performing sector on the market. And again, I think it is because the generalists and some of the sell-siders sell this notion that you can't trust these mining companies. As Mark Twain said, give me a miner, it's a hole in the ground with a liar standing in front of it. And, again, that means you have to find the information and the ownership and in the structure and the debt structure and the things that Rick Rule and Justra and Lassonde look at and follow that and do your own homework. But stepping back, it is a very, very obvious fat pitch longer term for the right miners, the right royalty companies, the right exploration companies. Because again, just because we hit all-time highs at the end of last year, beginning of this year, doesn't mean that gold's not going to go significantly higher from here, which means generational wealth can be made in the equity side of the play. It's just not the space that we at Von Greyers or myself individually opine to with any kind of professional detail or specific opportunities, but there's obviously some that I've named, but there's many more to choose from. Do your own homework. But for those looking for a little more juice out of the secular gold bull market, it's a fat pitch again. But again, I look at gold much more boringly, much more conservatively, much more traditionally as trying to preserve wealth, not trying to necessarily generate more wealth. Folks like Rick Rule have both of those mentalities, but it's in his DNA to get out high, find a new value, go low, and then ride it. And Rick Rule, I know quite well from many conversations, is very patient. He can wait years before he gets a signal. I think many investors, whether it's risk assets or mining stocks or even precious metals, their biggest problem is they don't know when to exit a trade. Entries and exits are very hard. The exit can be the hardest thing. With physical gold as a insurance policy against openly dying fiat currencies, I don't have to look at an exit for gold. I just know it holds its value longer. When I need liquidity, I convert it to a Swiss franc or euro or a dollar, and I spend in fiat. I save in the precious metal. Again, that goes back to Thomas Gresham. This is what smart family offices, smart investors who understand the sophisticated reasons behind gold ownership have always done for centuries. They certainly do it in Switzerland. I think more Americans and others are catching on to this as the dollar melts before them, or as the euro melts before them, or even the Swiss franc relative to these metals. Well, I love that question because it ties back to the bond market, which I still think is everything, from which you can look at every asset class, including precious metals. The sell treasuries buy gold trade is already threatening the U.S. and its bond market. And really, this is, since 2022, when the U.S. dollar was weaponized, that was a watershed moment. I think one of the most important moments in the 21st century for the dollar. And right after that dollar was weaponized, already an over-indebted U.S. dollar and over-indebted U.S. Treasury was then a weaponized U.S. Treasury. The de-dollarization meme became a growing reality, not just a meme. And many of us, including myself from day one, warned that this was a watershed moment. We saw 40 plus nations trading outside of the U.S. dollar. We saw Russian finance ministers like Kobayakov and Glassiev openly telegraphing and then later employing gold as a net settlement asset and collateral for global trade outside of the U.S. dollar and outside of the U.S. Treasury. And we saw almost 40 countries openly repatriating physical gold within their own borders. They were focusing on gold, not the U.S. Treasury. We've also seen, I've written about this for a year since 2022, it's culminating now, is the cracks in the petrodollar, which are critical buyers of sponges for U.S. treasuries and sponges for U.S. dollars. We've seen 20% oil sales outside of the petrodollar since 2023, 24. We've seen the rise of the BRICS pay, the Enbridge, the BRICS unit. These are all symptoms of nations wanting to bypass or go around the marginal line of the U.S. Treasury and the U.S. dollar. Even too big to fail banks like Morgan Stanley, traditionally no fan of gold, have offered an allocation of at least 20% gold from their 60-40 stock bond to a 60-20-20 portfolio in which gold plays a very big role. And I think you can't deny also that people forget that the BIS in the last couple of years made gold a tier one asset alongside of that laughable U.S. Treasury. That's an open symptom, an open signpost that even the BIS, again, of which I'm no fan, is basically saying the quiet part out loud. We now look at gold more than U.S. Treasuries. And, if that wasn't enough with all these other signals, you've got record-breaking levels of central bank gold stacking since we weaponized the dollar in 2022. It's up 5x as of this year from 2022. And it's still a net gold stacking positive right now. And of course, we've seen a mass exodus of physical gold and silver leaving the New York Common Exchange and the LBMA vaults in London, because nations want that physical monetary metal more than a paper claim on it. So again, before we even discuss what's happening now with the hockey puck of gold in the treasury or where that puck is going, let's just pause to remember the symptoms and the signposts. This is not a gold bug apology or a defense. Look at the de-dollarization. Look at the gold repatriation. Look at the BRICS tilt towards gold for net settling trades. Look at the tier one designation by the BS. Look at the petrodollar, the BIS, I shouldn't call it the BS. Look at the COMEX exodus. Look at Morgan Stanley's confessions. So these are all symptoms of where we've been just in the last 4 years with this gold moving towards and away from the U.S. Treasury. But for where that hockey puck lies today for the U.S. gold and for the U.S. Treasury, or for gold and U.S. Treasury, and as importantly, the direction of that puck, we just have to look again at those rising U.S. Treasury yields. I mean, the 10-year in the U.S. is up 75 basis points this year, and the Fed hasn't raised rates. That's a risk premium. The bond market is setting the rates. That's saying we do not trust and we do not like sovereign IOUs in general, and we really don't like the U.S. Treasury, that U.S. IOU in particular. This was, again, a very important signal. It's dispositive evidence of declining demand, which was really just declining trust in the U.S. Treasury, at the same time that central banks are net stackers of gold. And as you mentioned, central bank reserves are now much higher in gold than they were than they were 2 years ago. It was 10%, now they're 20%. Their dollar count went from 80% to 56%. Gold share of global FX reserves, as you said, is now greater than U.S. Treasuries. That's not a gold bug argument. That's not a gold bug case. That's just empirical data. And I'll end with this point too, Jess, because the very war or conflict that we find ourselves in, we can't call it a war because we haven't the Senate or the House behind it to declare it. But this very conflict in Iran is about the U.S. dollar and the U.S. Treasury and the fear of its declining interest, its declining hegemony. Remember, Iran gives its oil to China. China is looking to buy energy outside of the U.S. dollar. That is a massive gut punch to the U.S. dollar and therefore indirectly the U.S. Treasury. Because if more and more oil is sold outside of the petrodollar, that is a direct threat to the U.S. dollar, the U.S. Treasury, and to U.S. hegemony. So again, it is no coincidence that we've had regime change wars or freedom-based wars in oil-rich nations like Iraq, like Iran, and certainly like Libya, and even our regime change in Venezuela was based on protecting that U.S. dollar and U.S. Treasury. Why are they so nervous in this deadly serious game? Because demand for U.S. Treasuries is openly being replaced by physical gold. That is a massive, longer-term tailwind for patient investors, of which gold isn't even getting its legs yet. I think the evidence is dispositive rather than just apologetic from the gold camp.
Looking ahead, the outlook for precious metals remains closely tied to the future of the global monetary system. As government debt levels continue to rise and central banks face difficult policy choices, investors are increasingly questioning the long-term purchasing power of fiat currencies. In such an environment, hard assets often regain importance as stores of value and financial insurance. The bullish case for silver becomes even stronger when both monetary and industrial factors are considered together. Unlike many commodities, silver serves a dual role. It benefits from investor demand during periods of economic uncertainty, while also remaining essential for modern technologies and strategic industries. If supply growth continues to lag behind demand, the market could experience significant tightening. This is why some analysts believe future price moves may be far larger than most investors currently expect. Gold also remains central to the discussion, particularly as central banks around the world continue accumulating reserves. Whether the adjustment occurs gradually or suddenly, the underlying trends suggest that precious metals could play an increasingly important role in global markets. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.